Hello, friends. If you're serious about becoming a successful trader, you need to master your mindset, and there's no better guide for that than Mark Douglas. In today's video, we're diving into some powerful trading psychology lessons from his two iconic books, The Disciplined Trader and Trading in the Zone. These insights are not just theories, they're practical strategies that can transform how you think, act, and perform in the market. Whether you're struggling with emotions, fear of loss, or staying disciplined, the lessons we'll cover today will give you the tools to navigate the unpredictable world of trading with confidence and clarity. By understanding and applying these principles, you can take a huge step forward in your trading journey. So, stick around, because every topic we explore today could be the key to unlocking consistent success in the market. And hey, if you find this video helpful, don't forget to like, share, and subscribe for more insights to sharpen your trading psychology and strategies. Let's get started. Accepting uncertainty. One of the biggest mental shifts a trader must make is accepting that the market is inherently uncertain. Mark Douglas explains that no amount of technical analysis or fundamental research can eliminate the unpredictability of price movements. The market isn't something you can control. There are too many variables at play, many of which are invisible or unpredictable. Trying to predict every outcome only leads to frustration and poor decision-making. Douglas emphasizes that traders often struggle because they want certainty before placing a trade. This need for control creates fear of being wrong, fear of losing money, and fear of missing out. When a trader becomes emotionally attached to predicting the market, it leads to hesitation, overanalysis, and impulsive decisions. This emotional turmoil can cause them to deviate from their trading plan or hold on to losing trades, hoping the market will turn in their favor. Successful traders, however, adopt a completely different mindset. They understand that every trade carries a degree of randomness. No single trade defines their success. Instead of focusing on being right, they focus on following a process rooted in probabilities. For them, a winning edge is not about predicting individual outcomes. It's about executing trades consistently and letting the law of large numbers play out over time. Douglas argues that the market doesn't owe anyone a predictable pattern. By accepting this reality, you release yourself from emotional baggage. You stop tying your self-worth to the outcome of a trade and start approaching the market with a calm, objective mindset. This shift allows you to follow your plan without hesitation, knowing that losses are a natural part of the process and that the next trade always presents a new opportunity. Thinking in probabilities is one of the most crucial mental shifts a trader can make. Mark Douglas explains that the market is an environment where anything can happen, at any time, for any reason. No matter how much experience or knowledge you have, you can never predict the future with absolute certainty. This is why successful traders don't think in terms of being right or wrong. Instead, they view each trade as part of a larger probability game. Every trade you place has an uncertain outcome, but over a series of trades, patterns emerge. If your trading strategy has an edge, a statistical advantage, then over a large enough sample size, that edge will play out in your favor. This is the same principle that casinos rely on. In any given spin of the roulette wheel, the outcome is unpredictable. But over thousands of spins, the casino knows its statistical edge will generate profits. Traders who think in probabilities adopt a similar mindset. They don't focus on whether any single trade wins or loses. They focus on consistently following their system because they trust the long-term results. Mark Douglas points out that many traders struggle because they become emotionally attached to individual trades. When you believe you can predict the outcome, every trade feels personal. Winning trades boost your confidence, while losses feel like personal failures. This emotional cycle leads to hesitation, second-guessing, and impulsive decisions, making it difficult to stick to a plan. But when you shift to a probability-based mindset, that emotional attachment weakens. You no longer need to know what will happen next because you understand that a single trade is just one event in a much larger picture. Thinking in probabilities also helps you accept losses as a natural part of the process. Even with a profitable strategy, losing trades are inevitable. But when you view losses as statistical events rather than personal failures, they lose their emotional impact. Instead of fearing a loss, you accept it as the cost of doing business. This mindset allows you to stay calm and focused, making it easier to execute trades without hesitation. Another key point Mark Douglas emphasizes is that probabilities require consistency. For an edge to work, you must trade it consistently over time. If you pick and choose which trades to take based on how you feel, you disrupt the statistical balance and lose the benefit of your edge. Successful traders trust their system and execute it with discipline, knowing that over time, the probabilities will work in their favor. This mental shift reduces emotional stress, improves decision-making, and allows you to approach the market with confidence and clarity. Overcoming the fear of loss is one of the most important mental barriers every trader must break through. Mark Douglas explains that this fear is rooted in how people are conditioned to avoid failure. From a young age, mistakes are often punished and success is rewarded. This mindset carries over to trading, where losses feel like personal failures. But in reality, losses are an unavoidable part of the process. No strategy, no matter how effective, can guarantee a win every time. Accepting this truth is the first step toward freeing yourself from the emotional grip of fear. Fear of loss creates a destructive cycle. When you're afraid to lose, your mind goes into a defensive state. This can cause you to hesitate when you should act or exit trades too early to avoid potential losses. On the other hand, fear can also lead to holding losing trades longer than you should, hoping the market will turn in your favor. In both cases, fear clouds your judgment and pushes you away from rational, disciplined decision-making. Mark Douglas emphasizes that to overcome this fear, you must reframe how you see losses. Instead of viewing them as failures, treat them as a cost of doing business. Just like a shopkeeper accepts the cost of inventory, traders must accept that losses are part of the game. Each trade is just one event in a larger series. No single loss defines your ability as a trader. What truly matters is how well you follow your plan over time. One practical way to reduce fear is by fully accepting risk before you enter a trade. Many traders place trades hoping not to lose, but that mindset only fuels anxiety. Instead, Douglas suggests defining the risk clearly. Know how much you're willing to lose and be comfortable with that amount. Once the trade is live, the outcome is out of your control. By accepting the risk up front, you detach emotionally from the result, allowing you to focus on executing your strategy. Another key point Douglas highlights is the importance of building trust in your edge. Fear often arises from uncertainty, when you're not sure your strategy works or when you deviate from your plan. By sticking to a proven system and gathering data over time, you build confidence in your process. This confidence reduces the emotional impact of losses because you know they're temporary and expected within the larger framework of probabilities. It's also crucial to separate your self-worth from your trading outcomes. Many traders take losses personally, as if a losing trade reflects their value or intelligence. Douglas argues that this mindset is dangerous. A loss is simply a reflection of market probabilities. It says nothing about you as a person. When you internalize this truth, losses become easier to handle without the emotional baggage. This mindset is what separates consistently successful traders from those who let fear control their actions. Discipline is the foundation of successful trading. Mark Douglas emphasizes that no matter how skilled you are at analyzing the market, your ability to follow a plan consistently, without letting emotions interfere, is what ultimately determines long-term success. The market is unpredictable, and emotional reactions to wins or losses can quickly derail even the best strategies. Discipline is what keeps you grounded, ensuring that your decisions are based on logic, not feelings. Emotions like fear, greed, and overconfidence are natural in trading, but acting on these feelings leads to impulsive decisions. For instance, after a big win, you might feel invincible and start taking reckless trades. On the other hand, after a loss, fear may cause you to hesitate or avoid taking the next valid setup. These emotional swings pull you away from a rational process and make it nearly impossible to maintain consistency. Mark Douglas explains that disciplined traders treat trading like a business. Just as a successful business follows structured processes regardless of daily fluctuations, a trader must stick to a predefined plan. This means having clear rules for when to enter a trade, when to exit, and how much to risk. Once these rules are in place, the key is to follow them without second guessing or letting emotions influence your actions. One reason discipline is so challenging is that the market offers endless opportunities to deviate from your plan. Every moment presents new information, tempting you to react. But Douglas emphasizes that reacting emotionally is the opposite of discipline. Successful traders understand that no single trade defines their success. What matters is executing their strategy over hundreds of trades, allowing the probabilities to work in their favor. A disciplined approach also protects you from the emotional roller coaster that many traders experience. When you follow a plan, you no longer depend on outcomes to validate your decisions. Whether a trade wins or loses, your focus stays on following your process. This mindset reduces stress and allows you to stay calm, even during losing streaks. Mark Douglas suggests that building discipline starts with accepting that you can't control the market, but you can control your actions. This means trusting your plan even when emotions try to pull you in a different direction. For example, if your plan says to exit a losing trade, you must do it without hesitation, even if you feel like holding on and hoping for a reversal. Similarly, if your system signals a valid trade, that you must take it without fear, even if your last few trades were losses. Developing this kind of discipline requires practice and self-awareness. Douglas recommends reviewing your trades regularly to identify moments where emotions caused you to break your rules. By recognizing these patterns, you can work on correcting them and strengthening your ability to stay disciplined. By committing to a structured process and maintaining emotional control, you give yourself the best chance to succeed in the unpredictable world of trading. Self-awareness is a critical factor in becoming a successful trader. Mark Douglas emphasizes that understanding your own psychological tendencies and biases is just as important as understanding the market itself. The truth is, most trading mistakes aren't caused by a lack of technical knowledge. They come from emotional reactions and subconscious patterns. Without self-awareness, you'll keep repeating the same errors, no matter how much you know about charts or strategies. One of the first steps to developing self-awareness is recognizing that your mind is constantly influencing your trading decisions. Your beliefs, fears, and past experiences all shape how you interpret market information. For example, if you have a deep fear of losing money, you might hesitate to enter a valid trade or exit too early to avoid potential losses. On the flip side, if you're overly confident after a winning streak, you may take bigger risks without realizing it. These patterns operate in the background unless you actively bring them into focus. Mark Douglas points out that many traders fail because they blame external factors like market conditions or bad luck. But the real problem lies within your mental and emotional responses to uncertainty. Successful traders take responsibility for their behavior. They understand that the market doesn't force them to make decisions. It only presents opportunities. How you react is entirely up to you. To develop self-awareness, Douglas suggests observing your thoughts and emotions during trades. Pay attention to how you feel when you enter a position. Are you calm and focused or anxious and hesitant? What happens when the market moves against you? Do you follow your plan or does panic take over? By tracking these emotional responses, you start to identify patterns that may be sabotaging your success. Another key aspect of self-awareness is recognizing cognitive biases. For example, the confirmation bias makes you seek information that supports your current trade while ignoring evidence that contradicts it. The loss aversion bias causes you to hold on to losing trades longer than you should, because the pain of a loss feels greater than the joy of a win. These biases distort your perception of the market, leading to poor decisions. The more aware you are of these tendencies, the better you can guard against them. Douglas also emphasizes the importance of reviewing your trades objectively. Many traders only focus on whether a trade was profitable or not, but self-aware traders go deeper. They analyze whether they followed their plan, how they felt during the trade, and whether emotions influenced their actions. This kind of reflection helps you identify weaknesses and work toward improving your decision making process. A powerful way to increase self awareness is through journaling. Douglas encourages traders to keep a detailed journal of every trade, documenting not just the technical aspects, but also your emotional state and thought process. Over time, patterns emerge that reveal your strengths and weaknesses. This honest self assessment helps you catch emotional triggers before they lead to costly mistakes. By understanding how your mind works, you gain control over your behavior, which is essential for consistent success in the ever changing world of trading. One of the most powerful lessons in trading is learning to let go of the illusion of control. Mark Douglas emphasizes that no matter how much you study, analyze, or prepare, you will never have control over the market. The market is an environment of endless variables, driven by millions of people making independent decisions. Trying to control what happens next is not only impossible, but also a major source of stress and poor decision making. The only thing you can truly control is yourself, your actions, your mindset, and your responses to the market's movements. Many traders struggle because they want certainty. They want to believe that if they find the perfect strategy or analyze the market deeply enough, they can predict every outcome. But Douglas makes it clear, no system can guarantee what the market will do. There will always be unpredictable events and unexpected movements. The more you try to control the market, the more frustration and emotional turmoil you create for yourself. This need for control often leads to destructive behaviors. For example, when a trade moves against you, the urge to fix the situation can cause you to overtrade, move your stop loss, or refuse to accept a small loss, turning it into a much larger one. On the flip side, when a trade is profitable, the desire to lock in gains too early can prevent you from allowing a winning trade to reach its full potential. In both cases, the desire to control outcomes pushes you away from disciplined decision-making. Mark Douglas explains that the key to long-term success is accepting the market's uncertainty and focusing on what you can control, your actions and reactions. This means approaching every trade with the understanding that anything can happen. Once you accept this reality, you stop trying to force outcomes and start managing risk. You recognize that your job isn't to control the market. It's to execute your plan consistently, knowing that the probabilities will work in your favor over time. Letting go of control also means trusting your strategy. If you've developed a system with a proven edge, you don't need to interfere with it emotionally. Your focus should be on following your rules, not on whether any single trade wins or loses. When you trust the process, you stop reacting impulsively to short-term outcomes. Whether the market moves in your favor or against you, your job is simply to follow your plan without emotional interference. Another important point Douglas makes is that true confidence comes from this mindset of acceptance. When you no longer need to control outcomes, you trade with more freedom and clarity. Losses don't trigger panic because you understand they are part of the process. Wins don't lead to overconfidence because you know they are just one piece of a larger probability game. This emotional balance allows you to stay calm, make rational decisions, and maintain consistency over the long run. A practical way to reinforce this mindset is to fully accept the risk before entering any trade. Know exactly how much you're willing to lose and be at peace with that amount. Once you place the trade, the outcome is out of your hands. This mental shift frees you from the anxiety of trying to control what happens next. Your focus remains on executing your plan, not on chasing outcomes. This mindset is what separates professional traders from those who struggle. It's not about predicting the market perfectly. It's about controlling yourself in the face of uncertainty. Trading in the zone is a mental state where you execute trades effortlessly, without hesitation, fear, or overthinking. Mark Douglas explains that this zone is where the best traders operate, fully focused, emotionally detached, and completely in sync with the market. It's not about predicting every outcome perfectly, but about maintaining a calm, disciplined mindset that allows you to respond to market opportunities without second-guessing yourself. Most traders struggle to reach this state because they're constantly battling their emotions: fear, greed, hope, and regret. These feelings cloud judgment and lead to impulsive decisions. For instance, after a few losses, fear might cause you to hesitate when the next valid trade appears. On the other hand, after a big win, overconfidence may push you to take reckless trades. Both reactions pull you out of the zone and disrupt your ability to trade objectively. Douglas emphasizes that being in the zone requires a shift in how you think about trading. You must accept that the market is unpredictable and that any outcome is possible. Once you internalize this truth, you stop trying to control every trade. Instead, you trust your strategy and focus on the process rather than the result. This mental shift is crucial because it removes the emotional attachment to winning or losing. A key element of trading in the zone is detachment from outcomes. When you are too focused on whether a trade wins or loses, your emotions take control. But when you accept that no single trade defines your success, you free yourself from this pressure. You begin to see each trade as just one event in a larger series where probabilities play out over time. This perspective allows you to stay calm, follow your plan, and avoid emotional reactions. Another important factor is trust, both in your system and in yourself. If you've developed a trading plan with an edge, your only job is to execute it consistently. This means not questioning your decisions mid-trade or overanalyzing every movement. When your setup appears, you take the trade. If it meets your exit criteria, you close the trade. There's no hesitation, no second guessing, just pure execution. This automatic, confident action is a hallmark of trading in the zone. Douglas also highlights the importance of eliminating mental noise, the inner dialogue that causes doubt and hesitation. For many traders, past experiences shape their expectations. If you've had a series of losses, your mind may create fear about future trades. If you've had big wins, you might become overly eager. Both mindsets prevent you from staying present and fully engaged in the current moment. Trading in the zone means letting go of past outcomes and focusing entirely on what the market is showing you right now. One way to develop this mindset is through consistent mental conditioning. Douglas suggests reviewing your trades objectively, without judgment, so you can identify emotional triggers and correct them. By practicing self-awareness, you train yourself to remain calm and focused, regardless of external results. Over time, this mental discipline becomes second nature, allowing you to enter the zone more frequently. Another practical step is to reduce internal conflict by fully accepting the risk before you place a trade. When you accept that any trade can lose, you remove the emotional charge from the process. You no longer need the market to prove you right, and your decisions become more objective. This acceptance allows you to flow with the market, responding to opportunities without fear or attachment. When you reach this mental state, trading becomes less stressful and more consistent because your decisions are based on logic, not emotions. Managing expectations is one of the most overlooked aspects of successful trading. Mark Douglas emphasizes that unrealistic hopes or emotional highs after a win and the frustration or desperation after a loss are the root causes of many trading mistakes. When you approach the market with fixed expectations about how much you should win or when a trade has to work, you set yourself up for disappointment and emotional reactions that can sabotage your decision-making process. At the core of this issue is the belief that you can control the market's behavior. Douglas makes it clear, you can't. The market is a constantly changing, unpredictable environment where anything can happen. When you expect a particular outcome, you mentally lock yourself into that belief. If the market moves against you, it feels like a personal failure. This emotional attachment can lead to revenge trading, abandoning your plan, or taking reckless risks to make it back. On the flip side, when traders experience a big win, it often leads to overconfidence. That euphoria makes you feel like you figured it out, or that every future trade will be just as successful. This false sense of certainty pushes traders to increase their position size or ignore their risk management rules. But the moment the market shifts, that overconfidence can turn into panic, creating a dangerous emotional cycle. Douglas stresses that the healthiest mindset is to approach every trade without rigid expectations. Instead of focusing on how much you hope to win, focus on executing your strategy consistently. Accept that losses are part of the game and that no single trade defines your overall success. This mental flexibility allows you to respond to what the market is actually doing rather than what you want it to do. A practical way to manage expectations is to shift your focus from individual trades to long-term probabilities. No matter how reliable your system is, there will be losses. But if your plan has a statistical edge, those losses are just part of the larger process. For example, if your strategy wins 60% of the time, you should expect that 40% of your trades will lose. When you internalize this reality, losing trades become less emotionally charged. They're just part of the math. Another key point Douglas makes is the importance of detaching your self-worth from your trading results. Many traders take a winning streak as proof that they're skilled and a losing streak as a sign they're failing. This emotional connection to outcomes makes it harder to stay objective. Instead, successful traders measure their progress by how well they follow their plan, not by whether any one trade is a win or a loss. To reinforce this mindset, Douglas suggests predefining your risk for every trade. When you know exactly how much you're willing to lose and accept that amount mentally before you enter, it removes the emotional pressure. If the trade works, great. If it doesn't, it's just part of the process. This simple practice helps you stay grounded no matter the outcome. He also emphasizes the power of self-awareness. Pay attention to how your emotions shift based on your expectations. Are you feeling overconfident after a win? Are you chasing trades to recover from a loss? By recognizing these emotional patterns, you can step back and correct your mindset before it affects your behavior. This balanced, realistic approach helps you stay calm, stick to your plan, and make decisions based on logic, not on hope or fear. Risk acceptance is a cornerstone of successful trading. Mark Douglas emphasizes that to trade confidently and with a clear mind, you must fully accept the risks associated with every trade before you enter the market. Without this acceptance, fear and uncertainty will cloud your judgment, leading to hesitation, poor decisions, and emotional reactions. At its core, risk acceptance means understanding and being at peace with the possibility of losing money on any given trade. No matter how strong a setup looks or how confident you feel, the outcome of any trade is always uncertain. The market is a dynamic and unpredictable environment where anything can happen. News events, sudden price swings, or shifts in market sentiment can all impact your position. If you don't mentally accept that reality, every loss feels like a personal failure, and every trade becomes an emotional roller coaster. When traders fail to accept risk, they often fall into destructive patterns. Some hesitate to enter a trade, fearing it will go against them. Others refuse to cut losses, hoping the market will turn in their favor. Both behaviors stem from the inability to confront and accept the reality that losses are a normal part of trading. Douglas points out that this mindset not only leads to inconsistent results, but also prevents you from developing the emotional resilience required to succeed long-term. Fully accepting risk isn't about being careless. It's about knowing exactly how much you're willing to lose on each trade and being comfortable with that amount. This means defining your risk clearly before you enter the trade. How much of your account are you willing to put on the line? What is your stop-loss level? If the trade goes against you, can you walk away without feeling regret or frustration? These are the questions you must answer in advance. Douglas stresses that true risk acceptance allows you to trade with freedom and confidence. When you accept the possibility of loss, you remove the emotional charge from the outcome. You stop needing the market to behave a certain way, which reduces anxiety and prevents you from making impulsive decisions. Whether a trade wins or loses, your emotional state remains balanced because you've already accepted the risk as part of the process. A critical point Douglas makes is that partial risk acceptance is not enough. Many traders tell themselves they accept the risk, but deep down, they still hope to avoid losses altogether. This hidden resistance shows up in their behavior, moving stop losses further away, hesitating to take valid setups, or feeling a strong emotional reaction after a loss. True acceptance means you are fully prepared for any outcome, and no single trade can shake your confidence. One practical exercise Douglas suggests is to mentally own the potential loss before you place a trade. For example, if you're risking $500 on a trade, imagine that money already being gone. Can you still take the trade without feeling stressed? If the answer is no, you may be risking too much relative to your comfort level. Adjusting your position size until you feel at peace with the loss is a key step toward full risk acceptance. This mindset also helps you maintain consistency. When you accept the risks without emotional resistance, you're more likely to follow your trading plan with discipline. You no longer react impulsively or second guess your decisions because you're not afraid of the outcome. This emotional clarity allows you to stay focused on executing your edge, knowing that over a series of trades, the probabilities will work in your favor. Douglas also points out that risk acceptance fosters long-term confidence. When you stop fearing losses, you begin to trust yourself and your strategy more deeply. Each trade becomes a neutral event, a chance to express your trading plan, rather than an emotional battle. This mental shift is what separates professional traders from those who remain stuck in cycles of fear and hope. Consistency as a mindset is one of the most powerful lessons Mark Douglas emphasizes for long-term trading success. It's not just about following a set of rules. It's about cultivating a mental approach where you prioritize steady execution over being emotionally attached to the outcome of any single trade. According to Douglas, most traders focus too much on results, hoping for a big win or fearing a loss. This outcome-driven mentality leads to inconsistent behavior. Some days you follow your plan, other days you ignore it. This emotional back and forth is what prevents most traders from achieving lasting success. At the heart of a consistent mindset is the belief that the market is unpredictable in the short term, but over a large number of trades, patterns and probabilities play out reliably. Douglas explains that no one can control or predict what will happen next in the market. However, you can control how you respond. Consistency comes from focusing on executing your edge, the statistical advantage your trading plan provides, without being emotionally influenced by the outcome of any one trade. One major reason traders struggle with consistency is that they view each trade as a reflection of their intelligence or worth. When a trade wins, they feel like a genius. When it loses, they feel like a failure. This emotional roller coaster causes people to deviate from their plan, either by chasing trades after a win or avoiding valid setups after a loss. Douglas stresses that professional traders break this cycle by understanding that a single trade is meaningless on its own. What matters is how you perform over a series of trades. To develop a consistent mindset, Douglas encourages traders to redefine success. Instead of measuring success by how much money you make on one trade, measure it by how well you follow your process. Did you follow your plan? Did you accept the risk? If the answer is yes, then the trade was successful, regardless of whether it won or lost. This shift in focus removes the emotional charge from individual outcomes and allows you to approach each trade with the same calm, objective mindset. A key part of consistency is removing randomness from your decision-making process. Many traders fall into the trap of taking gut-feeling trades outside of their strategy. These impulsive decisions might work sometimes, but over time, they create chaos in your results. Douglas is clear. Consistency requires you to trust your edge and follow it without hesitation. Your job is not to predict the future, but to execute your plan consistently, knowing that the probabilities will work in your favor if you stick to them. Another important point Douglas makes is that consistency is a choice. You must decide to think and behave like a consistent trader before you can become one. This means committing to a set of rules and holding yourself accountable. For example, if your strategy says to risk 1% of your account on each trade, you must stick to that, no matter how confident or fearful you feel. This discipline builds the mental foundation for consistency over time. Douglas also emphasizes the importance of emotional neutrality. Consistent traders don't get overly excited after a win or devastated by a loss. Instead, they treat each trade as just another step in a larger process. This emotional detachment doesn't mean they don't care. It means they understand that the outcome of one trade does not define their overall success. By maintaining this balanced mindset, they avoid the impulsive decisions that derail most traders. A practical exercise Douglas suggests is to track your trades not by profit and loss, but by how well you followed your plan. Create a journal where you record whether you entered at the right spot, placed your stop loss correctly, and managed your emotions throughout the trade. Over time, this practice reinforces the idea that consistent execution, not random wins, is what leads to lasting success. Overcoming the need to be right is a crucial psychological shift that separates struggling traders from those who achieve long-term success. Mark Douglas emphasizes that many traders enter the market with a deep-seated desire to be right on every trade. This need stems from the belief that being wrong is a personal failure, a mindset rooted in ego rather than logic. However, in the unpredictable world of trading, this mentality is not only unrealistic but also destructive. At its core, the need to be right comes from the human instinct to seek validation. When a trade wins, it feels like proof that you are smart and capable. When a trade loses, it can feel like a blow to your self-worth. This emotional attachment to being right causes traders to make decisions based on ego rather than sound strategy. For instance, when a trade goes against them, traders who are obsessed with being right often refuse to accept the loss. Instead of cutting their position, they hold on, hoping the market will turn in their favor. This behavior frequently leads to larger losses because the trader is more focused on proving themselves right than protecting their capital. Douglas stresses that professional traders do not approach the market with the expectation of always being right. Instead, they focus on executing their strategy consistently, knowing that losses are a natural part of the process. They understand that no matter how skilled or experienced they are, predicting the market with 100% accuracy is impossible. What matters most is managing risk and maintaining discipline over a large number of trades. This perspective allows them to let go of individual outcomes and focus on long-term profitability. One of the main dangers of needing to be right is that it distorts your decision-making process. For example, if you are focused on proving yourself right, you may hesitate to take a necessary stop loss because admitting you were wrong feels painful. This leads to even greater financial and emotional damage as the loss grows. Similarly, after a winning trade, you might become overconfident, assuming you've figured out the market. This mindset can cause you to take reckless trades, leading to a rapid loss of profits. To overcome this psychological trap, Douglas suggests shifting your focus from being right to managing probabilities. Trading is not about perfection. It's about playing the odds over a series of trades. Imagine a professional gambler at a casino. They don't expect to win every hand, but they know if they follow their system and manage their bets correctly, they will be profitable over time. Successful traders think the same way. Each trade is just one part of a larger statistical game, where wins and losses balance out in the long run. A practical step Douglas recommends is adopting a neutral mindset before placing a trade. This means accepting that the trade can go either way and being emotionally prepared for both outcomes. When you enter the market with this attitude, you're no longer attached to being right. If the trade works out, great. You followed your plan. If it doesn't, you accept the loss and move on without emotional baggage. This mindset allows you to stay calm, objective, and focused on the bigger picture. Another exercise Douglas encourages is self-reflection. Ask yourself, why is being right so important to me? Is it about proving something to others? Is it about avoiding feelings of failure? By identifying the emotional drivers behind your need to be right, you can begin to dismantle them. The goal is to separate your identity from your trading results. You are not defined by a single trade. Your success is measured by how consistently you follow your process over time. Letting go of the need to be right also helps you accept uncertainty. The market is full of unknown variables, and no amount of knowledge can eliminate that uncertainty. The sooner you embrace this reality, the easier it becomes to make rational decisions. When you stop trying to control the market or predict every move, you free yourself from the emotional stress that derails most traders. Emotional detachment is one of the most critical skills for long-term trading success. Mark Douglas emphasizes that successful traders do not allow emotions to dictate their decisions. Instead, they maintain a clear, objective mindset that allows them to follow their strategy consistently, regardless of whether they're winning or losing. This ability to separate feelings from trading decisions is what allows professionals to stay disciplined while others fall victim to impulsive reactions. The challenge is that trading naturally triggers strong emotions, especially fear and greed. When money is on the line, these emotions can cloud judgment and lead to irrational behavior. For example, fear might cause you to exit a winning trade too early because you're afraid of losing your profits. On the other hand, greed can make you hold on too long, hoping for a bigger win, even when your strategy signals it's time to exit. These emotional reactions prevent you from making logical decisions and often lead to inconsistent results. Douglas explains that emotional detachment doesn't mean you stop feeling emotions. It means you don't let those emotions control your actions. The goal is to observe your feelings without reacting to them impulsively. This requires understanding that the market itself is neutral. It doesn't care if you win or lose. The outcome of any single trade is not a reflection of your intelligence or self-worth. Once you accept this, it becomes easier to approach each trade with a calm, rational mindset. One of the main reasons traders struggle with emotional detachment is that they personalize their trades. When a trade wins, they feel smart and successful. When it loses, they feel like a failure. This emotional roller coaster creates a destructive cycle. After a big win, overconfidence may cause reckless trades. After a loss, fear may prevent you from taking valid opportunities. Douglas argues that professional traders avoid this cycle by recognizing that each trade is just a small part of a larger probability game. They don't judge themselves based on individual outcomes. Instead, they focus on following their edge consistently over time. A practical way to develop emotional detachment is by fully accepting the risk before entering a trade. Douglas emphasizes that if you are uncomfortable with the potential loss, you're more likely to make emotional decisions. Before placing a trade, ask yourself, can I accept losing this amount without hesitation? If the answer is no, either reduce your position size or skip the trade. By accepting the risk up front, you free yourself from the emotional burden of worrying about the outcome. Another powerful technique Douglas suggests is developing a mechanical mindset. This means treating your trading plan like a machine. Your job is simply to execute the process without questioning or second guessing. Imagine yourself as a technician following a set of rules. When the rules signal an entry, you enter. When they signal an exit, you exit. This mechanical approach removes the need for emotional decision-making. The more you trust your process, the less you rely on feelings to guide your actions. Douglas also highlights the importance of mindfulness and self-awareness. Pay attention to your emotional state while trading. Are you feeling anxious, overconfident, or frustrated? These emotional cues can signal that you're about to make an impulsive decision. By recognizing these feelings in real time, you can pause and refocus on your strategy. Practicing emotional awareness allows you to catch yourself before your emotions take over. Journaling your trades is another tool Douglas recommends for emotional detachment. After each trade, record not just the technical details, but also how you felt during the process. Did fear cause you to exit early? Did excitement make you increase your position size? Over time, this journal will reveal patterns in your emotional behavior. By identifying these triggers, you can work on reducing their influence and maintaining greater objectivity. Douglas also points out that emotional detachment requires shifting your mindset about losses. Many traders view losses as failures to be avoided. But in reality, losses are an inevitable part of trading. No system wins 100% of the time. Instead of fearing losses, accept them as the cost of doing business. When you stop resisting losses emotionally, they lose their power to disrupt your decision-making. Mark Douglas emphasizes that your belief system plays a powerful role in shaping your trading decisions and overall performance. Whether you realize it or not, the way you think about money, risk, and success is deeply influenced by your subconscious beliefs. These beliefs act like an internal framework, guiding how you interpret market information and how you respond to wins and losses. If your beliefs are limiting or negative, they can silently sabotage your ability to trade consistently and confidently. At the core of Douglas's message is this: you don't trade the market, you trade your beliefs about the market. Two traders can look at the same chart and see completely different opportunities simply because of how their belief systems shape their perception. If you believe the market is unpredictable and dangerous, you're more likely to hesitate, overanalyze, and avoid taking trades. On the other hand, if you believe the market is an environment of opportunity where you can execute a well-defined edge, you'll approach trading with confidence and clarity. The problem is that most traders are unaware of the beliefs operating beneath the surface. Many limiting beliefs are formed early in life through experiences with money, authority figures, and past failures. For example, if you grew up hearing phrases like money doesn't grow on trees or you have to work hard for every dollar, you might subconsciously associate financial success with struggle and scarcity. In trading, this belief can cause you to feel guilty about winning too easily or make you unconsciously sabotage profits. Similarly, if you believe being wrong is a sign of weakness, you may hold on to losing trades far too long just to avoid admitting a mistake. Douglas argues that if you want to succeed as a trader, you must identify and reshape these hidden mental barriers. The first step is to bring them into your awareness. Pay attention to how you react during trading. What thoughts and emotions surface when you're winning or losing? Are you afraid to pull the trigger because you fear being wrong? Do you feel undeserving when you make easy profits? These reactions are clues that point to deeper, limiting beliefs. One effective method Douglas suggests is self-inquiry, actively questioning your beliefs to uncover whether they serve you or hold you back. Ask yourself questions like, what do I believe about my ability to succeed as a trader? Do I believe losses mean I'm a failure? Do I trust myself to follow my plan, or do I doubt my decisions? By examining these beliefs, you start to see how they influence your behavior. For instance, if you believe you can't trust yourself, you'll second-guess every decision, which leads to hesitation and missed opportunities. If you believe the market is out to take your money, you'll trade defensively, cutting profits short while letting losses run. Once you identify limiting beliefs, the next step is to reprogram your mindset with empowering beliefs that align with successful trading. Douglas emphasizes that this isn't about positive thinking. It's about internalizing beliefs that reflect the true nature of the market. For example, instead of believing I need to be right to succeed, replace that with I only need to execute my edge consistently to be profitable. This new belief removes the emotional pressure to be perfect and focuses on following a system. Another belief shift is understanding that losses are a normal part of the game. They are not a reflection of your intelligence or self-worth. Professional traders fully accept that not every trade will be a winner, but they trust that their edge will play out over time. By adopting this belief, you free yourself from the emotional pain of being wrong, which allows you to take losses quickly and objectively. Douglas also highlights the power of visualization in changing belief systems. When you consistently visualize yourself trading calmly, following your plan, and accepting losses without emotional turmoil, you start to rewire your subconscious mind. This mental rehearsal makes it easier to stay disciplined in real time. Just as an athlete visualizes peak performance before a competition, traders can use the same technique to reinforce positive beliefs and behaviors. One of the most important beliefs to cultivate, according to Douglas, is trusting yourself. Successful traders believe in their ability to make decisions, manage risk, and handle whatever the market throws at them. Without self-trust, you'll always be second-guessing and reacting emotionally. Building this trust requires consistent action, following your plan, learning from mistakes, and proving to yourself that you are capable. By aligning your belief system with the realities of the market and the mindset of successful traders, you develop the psychological foundation needed for long-term success. Adapting to change is a crucial skill for any trader, and Mark Douglas emphasizes that the ability to stay mentally flexible is what separates successful traders from those who struggle. The market is constantly evolving. What worked yesterday may not work tomorrow. If you approach trading with a rigid mindset, you're setting yourself up for frustration and losses. Douglas argues that to thrive in the markets, you must embrace uncertainty and adjust your strategies without emotional resistance. At its core, trading is a dynamic environment. No 2 days are the same, and there are no guarantees. Many traders, however, fall into the trap of wanting the market to be predictable. They develop a belief that if they find the perfect system or pattern, they will always win. This desire for certainty leads to a dangerous mindset. When the market shifts, they resist the change, hoping their old methods will work again. Instead of adapting, they double down on losing strategies or avoid making necessary adjustments, which leads to further losses. Douglas explains that this resistance to change comes from our natural desire for security. The human brain is wired to seek patterns and avoid uncertainty because in most areas of life, predictability equals safety. But the market operates on probabilities, not certainties. Traders who cannot accept this reality become trapped by their emotional attachment to what should happen, rather than what is happening. This emotional rigidity blinds them to new opportunities and prevents them from responding effectively to evolving market conditions. One of the biggest psychological barriers to adapting is the fear of being wrong. When the market changes and a strategy stops working, admitting that requires acknowledging that your previous approach was incorrect. For many traders, this feels like a personal failure, so they hold on to their old methods, hoping things will return to normal. But Douglas makes it clear, being wrong is not the problem. It's refusing to accept that you're wrong that leads to disastrous outcomes. Professional traders don't take it personally when market conditions shift. They simply recognize the change and adjust their approach without emotional attachment. To cultivate mental flexibility, Douglas emphasizes the importance of maintaining a probability-based mindset. This means accepting that no strategy will work all the time and that losses are a natural part of trading. Instead of clinging to a rigid system, mentally flexible traders focus on reading the market as it is, not as they want it to be. They understand that the market gives constant feedback, and their job is to listen and respond accordingly. When a strategy shows signs of weakness, they adapt without hesitation, knowing that survival depends on staying aligned with the market's current behavior. Another key to adapting is letting go of expectations. Many traders enter the market with a fixed idea of how it should behave. If the market doesn't meet these expectations, frustration and confusion take over. Douglas argues that this mindset is dangerous because it blinds you to reality. Instead, he advises approaching every trading session with an open mind. Ask yourself, what is the market telling me right now? And be willing to shift your approach if the evidence suggests a change. A practical way to develop this mental flexibility is by constantly reviewing your trades and strategies. Douglas suggests keeping a trading journal to track your decisions, the market context, and the outcomes. Regularly reviewing this information helps you spot patterns of change early and adjust your behavior. For instance, if you notice that a previously reliable setup is no longer yielding results, it's a sign to either refine your approach or move on to new opportunities. This proactive adjustment prevents small losses from becoming large ones and keeps you in tune with the market's rhythm. Another helpful tool Douglas recommends is detaching your identity from your methods. Many traders become emotionally invested in a particular strategy or market view because it represents their intelligence or self-worth. When the market contradicts them, it feels like a personal attack, which triggers defensive reactions. Successful traders avoid this trap by understanding that their identity is not tied to any one method. Their goal is not to be right. Their goal is to be profitable. If that means changing their approach, they do so without ego or resistance. Douglas also emphasizes the value of staying curious and open-minded. Markets evolve due to changes in technology, economic conditions, and global events. What works in a bull market may fail in a bear market. By adopting a mindset of continuous learning, you remain adaptable. This means studying new techniques, observing other successful traders, and being willing to experiment. When you view change as an opportunity rather than a threat, you free yourself from the emotional paralysis that traps so many traders. Mark Douglas emphasizes that successful trading comes from focusing on the process, not the outcome. Most traders become obsessed with profits and losses, constantly measuring their self-worth based on whether a trade is a win or a loss. But this mindset is a trap. It leads to emotional reactions, inconsistent decisions, and ultimately, poor performance. Douglas argues that if you want to succeed long term, your priority should be executing your trading plan with discipline and precision, regardless of the short term results. The problem with focusing on outcomes is that it puts you at the mercy of factors you can't control. No matter how much analysis you do, you can never predict the market's next move with 100% certainty. Every trade has an element of randomness, and no strategy works perfectly all the time. If you measure success only by whether a trade wins or loses, you will constantly ride an emotional roller coaster, feeling euphoric when you win and devastated when you lose. This emotional volatility makes it nearly impossible to maintain the clear, objective mindset required for consistent trading. Douglas explains that the market is a probability-based environment. Each trade is just one event in a larger statistical game. Professional traders understand this reality and focus on the quality of their decisions rather than the immediate outcome. They know that even a perfectly executed trade can result in a loss because losses are simply part of the game. What matters is following the plan consistently because over time, a solid plan with a real edge will produce profits. By focusing on the process, you allow the law of large numbers to work in your favor. One reason many traders struggle to adopt this mindset is the need for instant gratification. People are naturally wired to want immediate rewards. When you take a trade, you want to see an immediate profit. It feels like validation that you were right. But Douglas argues that this obsession with being right is dangerous. It leads to emotional mistakes like cutting winners too early, holding losers too long, or abandoning your system after a few losses. Instead of chasing quick wins, the goal should be to execute every trade according to your plan, knowing that the long-term outcome will take care of itself. Douglas emphasizes that discipline is the key to focusing on the process. Discipline means sticking to your rules without second-guessing or letting emotions interfere. This means following your entry and exit criteria, respecting your stop losses, and not overtrading when the market isn't offering clear opportunities. When you commit to the process, you eliminate the emotional chaos caused by random outcomes. Over time, this discipline leads to more consistent and predictable results. A powerful mental shift Douglas suggests is to redefine what winning means. Instead of measuring success by the size of your profits, define success as executing your plan flawlessly. If you followed your process and the trade resulted in a loss, that's still a win because you did your job as a trader. This mindset frees you from the emotional highs and lows of individual trades and allows you to maintain confidence even during losing streaks. Traders who obsess over outcomes often panic and abandon their systems after a few losses. But those who focus on the process trust that the system will work over time. One practical way to reinforce this mindset is by keeping a process-oriented trading journal. Douglas advises that you track not just your profits and losses, but also how well you followed your plan. Did you enter at the right point? Did you stick to your stop loss? Did you manage your emotions? By reviewing your journal regularly, you start to see patterns in your behavior and can identify areas for improvement. This reflective process helps you focus on execution rather than immediate results. Another strategy Douglas suggests is mental rehearsal, visualizing yourself following your plan with precision. This practice conditions your mind to stay calm and focused during live trading. Imagine yourself executing trades without hesitation, accepting losses without frustration, and sticking to your rules no matter what the market does. The more you train your mind to prioritize the process, the easier it becomes to stay detached from individual outcomes. Douglas also emphasizes the importance of trusting your edge. If your trading system has been tested and has a genuine statistical advantage, you don't need to worry about any single trade. Your edge will play out over a large number of trades, but only if you execute consistently. By focusing on the process, you let go of the need to control individual outcomes and instead trust the probabilities to work in your favor. Mark Douglas highlights revenge trading as one of the most destructive behaviors a trader can engage in. It's that impulsive urge to get back at the market after a loss, to recover your money quickly by taking trades driven by frustration rather than logic. This emotional reaction is dangerous because it pulls you out of a rational, disciplined mindset and throws you into a cycle of careless decisions and bigger losses. At the heart of revenge trading is the emotional pain of losing. Losses in trading feel personal. They challenge your sense of control and self-worth. When a trade goes against you, especially if it's a big or unexpected loss, there's a natural human tendency to want to fix the situation immediately. Your mind shifts from logical analysis to emotional urgency. Instead of following your trading plan, you take impulsive positions, hoping to make back what you lost. But Douglas emphasizes that this mindset is a trap. Acting out of anger or desperation blinds you to the market's actual behavior and increases the likelihood of further mistakes. One key reason revenge trading is so harmful is that it disconnects you from your strategy. Successful trading relies on a disciplined process, clear entry and exit points, proper risk management, and the ability to stick to your rules. When you're in a revenge state, these guidelines go out the window. You might increase your position size recklessly, ignore stop losses, or take low-quality trades that don't fit your system. This emotional spiral often leads to larger losses, which only intensifies the desire to recover, creating a vicious cycle of emotional trading. Douglas explains that revenge trading is rooted in the need to avoid emotional discomfort. Losing money triggers feelings of failure, insecurity, and frustration. Many traders struggle to sit with these emotions, so they act impulsively to erase the loss as quickly as possible. But by doing so, they are actually increasing their emotional attachment to outcomes, making future losses even harder to accept. This cycle of emotional reactivity not only damages your account, but also destroys your mental clarity and long-term confidence. A critical shift that Douglas recommends is reframing how you view losses. Instead of seeing a loss as a personal failure, recognize it as a natural part of trading. Losses are unavoidable. Even the best traders experience them regularly. What separates successful traders is their ability to accept losses without emotional resistance. Each trade is just one event in a larger statistical framework. If you focus on executing your strategy consistently, individual losses become insignificant in the bigger picture. This mindset frees you from the emotional need to fight back against the market. To avoid the trap of revenge trading, Douglas emphasizes the importance of emotional awareness. Recognize the signs of emotional reactivity before they take control. If you find yourself feeling frustrated, anxious, or desperate after a loss, that's a clear warning signal. These emotions cloud your judgment and push you toward impulsive decisions. The best response is to pause and regain your mental clarity before making another trade. One practical strategy Douglas suggests is stepping away after a loss. When you feel the urge to chase the market, take a break. Physically remove yourself from the screen. This interruption breaks the emotional cycle and gives your rational mind time to re-engage. Use this time to review your trading journal, reflect on the loss objectively, and remind yourself that your job is to follow your plan, not to win back losses immediately. By creating space between the loss and your next decision, you regain control over your emotions. Another powerful tool is defining your risk and accepting it fully before entering any trade. Douglas emphasizes that when you mentally accept the possibility of a loss up front, it becomes easier to handle emotionally if it happens. This acceptance prevents you from being blindsided by the outcome and reduces the emotional charge that triggers revenge behavior. Treat every trade as an isolated event. If the market proves you wrong, it's simply feedback, not a personal attack. Douglas also advises developing a post-loss ritual to reset your mindset. After a losing trade, instead of reacting impulsively, engage in a structured process to review what happened. Ask yourself, did I follow my trading plan? Was the loss due to market randomness or a mistake? What can I learn from this experience? By treating losses as learning opportunities rather than personal defeats, you shift your focus from emotional reactions to continuous improvement. This reflective practice helps you stay grounded and prevents you from falling into the emotional spiral of revenge trading. Lastly, Douglas stresses the importance of trusting your edge over the long run. If your trading strategy is built on a solid statistical advantage, short term losses are just part of the process. Obsessing over individual outcomes distracts you from this bigger picture. By maintaining discipline and focusing on executing your system consistently, you allow the probabilities to work in your favor without the need for emotional retaliation. Successful traders understand that their power lies not in forcing outcomes, but in maintaining discipline and responding to the market with a calm, focused mind. Confidence in trading doesn't come from winning trades, it comes from preparation. The more you understand and trust your trading system, the less emotional uncertainty you'll feel when executing trades. Confidence isn't something you can fake or force. It's built through consistent effort, deep understanding, and real world experience with your system. One of the biggest reasons traders lack confidence is uncertainty about their edge. If you don't fully understand why your strategy works, you'll constantly second guess your decisions. Douglas points out that when traders aren't sure about their system, they become vulnerable to emotional swings, feeling overconfident after wins and fearful after losses. This emotional instability leads to inconsistency in execution, which sabotages long-term success. The solution? Thorough preparation. Douglas stresses the importance of deeply analyzing and testing your trading system before you risk real money. This means understanding every aspect of your strategy, your entry criteria, exit rules, risk parameters, and the logic behind them. When you know exactly why your system works and have tested it across various market conditions, you develop a rational foundation for confidence. A key part of preparation is backtesting. This process involves analyzing how your strategy would have performed historically. By doing this, you gain clarity on the system's strengths, weaknesses, and potential outcomes. Douglas explains that successful traders approach backtesting as a way to build belief in their edge. When you see consistent results across hundreds of trades, you internalize the idea that your system works over time, even if individual trades produce random outcomes. Beyond backtesting, Douglas emphasizes the value of forward testing, also known as paper trading. This means applying your strategy in real time without risking actual capital. It allows you to experience the emotional dynamics of trading while building trust in your process. As you see your system perform consistently in live market conditions, your confidence grows naturally. This gradual exposure helps bridge the gap between theoretical knowledge and practical execution. Another critical element of preparation is knowing your probabilities. Douglas repeatedly points out that no system wins all the time. Even the most profitable traders experience losses. The key is understanding that a single trade is just one event within a larger statistical framework. For example, if your strategy has a 60% win rate, you know that 40% of trades will be losses. But over a large sample size, the edge plays out. Internalizing these probabilities helps you stay calm and confident, even during losing streaks. Douglas also highlights the importance of personalizing your trading system. It's not enough to copy someone else's method. You need a strategy that fits your personality, risk tolerance, and time frame. When your system aligns with who you are, it becomes easier to follow consistently. Traders who adopt methods that don't match their psychological makeup often struggle with self-doubt and impulsive decisions. Confidence also comes from defining your risk clearly. Before entering any trade, know exactly how much you're willing to lose. Douglas emphasizes that when you accept this risk up front, there's no emotional surprise if the trade goes against you. This mental preparation frees you from the fear of loss and allows you to execute your plan without hesitation. Without clear risk parameters, every trade becomes a psychological battle, which erodes confidence over time. Douglas suggests creating a trading plan checklist to reinforce your preparation. This checklist should outline your strategy's core rules, including specific entry and exit criteria, position sizing and risk limits, market conditions to trade or avoid. By following a structured checklist, you reduce uncertainty and develop trust in your process. Over time, this routine strengthens your belief in your system and prevents emotional decision-making. Another powerful technique Douglas recommends is visualization. Mentally rehearse your trading scenarios, both winning and losing. Imagine how you will respond if a trade hits your stop loss or exceeds your profit target. This mental preparation desensitizes you to emotional triggers and helps you stay composed under pressure. When you've already visualized every possible outcome, the actual experience feels familiar, making it easier to act with confidence. Douglas also warns against seeking confidence from external validation, such as following market opinions or relying on other traders' views. True confidence comes from internal certainty, knowing that you've done the work to understand your edge. When you rely on others, you lose faith in your own decisions. But when you trust your preparation, external noise becomes irrelevant. Importantly, confidence grows through consistency. Douglas emphasizes that confidence is a byproduct of repeatedly executing your system, trade after trade. When you follow your rules without deviation, you build evidence that your process works. This evidence becomes the foundation of unwavering self-trust, even when faced with uncertainty. One of the biggest traps traders fall into is believing too strongly in market patterns. While it's true that technical analysis relies on identifying patterns, Douglas warns that these patterns are not guarantees. They are only probabilities. The market is driven by countless variables, including human emotions, global events, and economic data. No pattern, no matter how reliable it seems, can predict the future with absolute certainty. The danger lies in overinterpreting patterns and assuming they will always lead to the same outcome. Douglas points out that the human brain is naturally wired to seek order and predictability. This tendency can lead traders to see patterns where none actually exist. For instance, after spotting a chart formation that has worked several times before, traders may become overconfident, believing it must work again. But in reality, every trade is a unique event. Past patterns do not dictate future price movements. A key mistake traders make is treating patterns as certainties rather than probabilities. Douglas explains that no matter how many times a pattern has worked in the past, there is always a chance it won't work this time. Successful traders understand that the market operates on random distribution. Even with a proven edge, the outcome of any single trade is unpredictable. The problem comes when traders emotionally invest in the idea that a pattern must work, leading to frustration or reckless decisions when it doesn't. Douglas also highlights the risk of confirmation bias, the tendency to interpret information in a way that supports pre-existing beliefs. For example, if you strongly believe a pattern will lead to a price breakout, you may overlook signs that the market is weakening. This bias can blind you to new information that contradicts your expectations. Traders who fall into this trap often hold on to losing positions longer than they should, hoping the pattern will eventually work. To overcome the illusion of market patterns, Douglas suggests adopting a probabilistic mindset. This means accepting that patterns provide an edge over many trades, but cannot guarantee the outcome of any individual trade. When you think in probabilities, you stop needing to be right on every trade. Instead, you focus on following your process consistently, knowing that your edge will play out over time. Douglas emphasizes the importance of detaching from the outcome of any single trade. If you believe too strongly in a pattern, you risk becoming emotionally attached to the trade's success. This attachment can cloud your judgment, making it harder to cut losses or stick to your rules. By recognizing that patterns only offer a statistical edge, not certainty, you free yourself from this emotional burden. A powerful strategy Douglas recommends is defining your risk before every trade. When you accept the possibility that any pattern can fail, you prepare yourself mentally to handle losses without emotional distress. By setting clear stop-loss levels and sticking to them, you protect your capital and prevent small losses from turning into catastrophic ones. Another critical point Douglas makes is that patterns only work within the right context. A pattern that performs well in one market condition may fail in another. For example, a breakout pattern might work reliably in a trending market, but fail repeatedly in a choppy, sideways market. Successful traders adapt their strategies to the broader market environment instead of blindly following patterns. Douglas also suggests keeping detailed records of your trades. This allows you to track how often certain patterns succeed or fail under various conditions. Over time, This data helps you identify which patterns genuinely provide an edge and which ones are unreliable. By grounding your decisions in objective analysis rather than assumptions, you make more rational trading choices. Ultimately, Douglas argues that the key to long-term success is letting go of the illusion that patterns guarantee outcomes. The market is inherently uncertain, and no amount of analysis can remove that uncertainty. By accepting this reality and focusing on executing your plan with discipline, you shift from being emotionally reactive to being calm and methodical. One of the biggest psychological challenges traders face is carrying emotional baggage from past trades into their current decisions. Whether it's the pain of a big loss or the euphoria of a major win, these experiences can distort your judgment and prevent you from trading objectively. Douglas argues that to succeed consistently, you must neutralize the emotional impact of past experiences and approach each trade with a clear, present-focused mindset. When traders hold on to past losses, it often leads to fear and hesitation. Imagine you took a significant loss after following a setup that seemed perfect. The next time you see a similar opportunity, instead of executing your plan, you freeze, haunted by the memory of that previous failure. This emotional residue makes you second-guess your strategy, causing missed opportunities or late entries that throw off your risk-to-reward ratio. Douglas explains that this hesitation isn't based on the current market reality. It's your mind reacting to an old wound. On the flip side, past wins can create a dangerous sense of overconfidence. After a big win, it's easy to believe you've figured out the market. This belief often leads to reckless behavior, taking trades outside your plan, increasing position sizes, or ignoring warning signs. According to Douglas, this kind of emotional high detaches you from the reality that each trade is a unique event. The market doesn't care about your last win, and neither should you if you want to maintain consistency. A key insight Douglas shares is that the past has no influence on future market behavior. Each moment in the market is independent. What happened before doesn't dictate what happens next. But if you're emotionally attached to past experiences, you start projecting those emotions onto future trades. This creates a mental loop where your past mistakes or victories control your present decisions, making you reactive rather than strategic. To break free from this pattern, Douglas suggests developing emotional neutrality, a state where you view every trade without the emotional baggage of previous outcomes. This doesn't mean ignoring your experiences. It means acknowledging them without allowing them to shape your decisions. The goal is to treat each trade as a fresh, independent event, judged only by its probabilities, not by your past. One effective strategy Douglas recommends is mindful awareness, training yourself to recognize when past emotions are influencing your present decisions. For example, if you feel hesitation before a trade, pause and ask yourself, am I responding to the market right now, or am I reacting to a past experience? By bringing these emotions to the surface, you create the mental space to choose a rational response instead of an emotional one. Another tool Douglas suggests is mental rehearsal. Before you trade, visualize potential outcomes, winning, losing, breaking even, and mentally prepare yourself to accept any result without emotional attachment. This process helps desensitize you to the emotional highs and lows, making it easier to stay grounded and present. When you've already experienced all possible outcomes in your mind, the actual result feels less personal and more like part of a statistical process. Douglas also emphasizes the importance of self-talk. The internal dialogue you have during trading can either reinforce emotional baggage or help release it. Instead of saying, "I can't afford another loss," shift to, "This is just one trade out of many. I trust my process." This subtle change in language reprograms your mind to stay focused on executing your plan rather than fixating on past outcomes. A practical step to neutralize past experiences is keeping a trading journal. Douglas encourages traders to record not just their trades, but also their emotional states. By writing down your thoughts and feelings after each trade, you can identify patterns of emotional interference and work to detach from them. Over time, this practice helps you separate your identity from your trading results. You are not your last trade, and your past doesn't define your future. One of Douglas's most powerful insights is that true freedom in trading comes from accepting the inherent uncertainty. If you cling to past experiences, you're subconsciously trying to control an uncontrollable market. But when you accept that every trade is an isolated event with uncertain outcomes, you free yourself from the emotional weight of past wins and losses. This mindset allows you to trade with clarity, consistency, and confidence. Mark Douglas emphasizes that impulse control is a critical skill for traders who want to succeed consistently. In the heat of market activity, the temptation to react instantly can be overwhelming, whether it's jumping into a trade out of excitement or cutting a position too early out of fear. However, Douglas argues that these knee-jerk reactions are often emotional responses, not rational decisions. To achieve long-term success, you must train yourself to evaluate and act with intention rather than reacting impulsively to every market fluctuation. At the core of impulse-driven behavior is the desire for immediate relief from fear, anxiety, or even the excitement of potential profits. When a trade moves quickly, your mind perceives it as a threat or opportunity that demands an instant response. This triggers the brain's fight or flight mechanism, pushing you to act without fully processing the situation. Douglas explains that while this instinct may have been useful for survival, it is destructive in trading, where patience and precision are key. Impulse trading often stems from emotional discomfort. For example, if the market starts moving against you, your natural reaction may be to exit the trade immediately to avoid further losses. On the surface, this seems reasonable, but Douglas points out that this kind of impulsive exit ignores the bigger picture. If the trade still aligns with your strategy, cutting it prematurely means you're not allowing your edge to play out. Similarly, when a trade moves in your favor, the impulse to take quick profits can prevent you from capturing the full potential of a move. A major problem with acting on impulses is that it erodes your ability to follow a structured trading plan. Every time you react impulsively, you reinforce the habit of emotional decision-making. Over time, this weakens your discipline and makes it harder to trust your process. Douglas emphasizes that successful traders are not those who never feel impulses. They are the ones who learn to pause and evaluate before acting. This pause creates a mental gap where rational analysis can override emotional urges. To master impulse control, Douglas recommends building awareness of your emotional triggers. Recognize the situations that typically lead to impulsive decisions, whether it's the fear of missing out, FOMO, the panic of a losing position, or the excitement of a winning trade. Once you identify these triggers, you can start to interrupt the automatic reaction by deliberately pausing before you take action. This brief pause gives you time to check whether your decision aligns with your plan or if it's just an emotional reflex. One practical strategy Douglas suggests is using predefined rules to guide your decisions. For instance, before you enter any trade, set clear parameters for entry, exit, and stop-loss levels. These rules act as guardrails, preventing you from making impulsive changes in the heat of the moment. If you feel the urge to act outside these rules, that's a signal to pause and ask yourself, is this decision based on my plan, or is it an emotional reaction? This simple question can help you regain control over your impulses. Another powerful technique is mental rehearsal. Before the trading day starts, visualize different market scenarios, both favorable and unfavorable, and imagine yourself responding calmly and rationally. By mentally practicing patience, you condition your brain to pause and evaluate under real-time pressure. Over time, this exercise strengthens your ability to stay composed when faced with sudden market movements. Douglas also emphasizes the importance of breathing techniques to manage impulsive urges. When you feel a strong emotional reaction rising, take a slow, deep breath and exhale gradually. This physical act slows down your nervous system and shifts your brain from an emotional state to a logical one. This brief reset helps you recenter your focus and evaluate the situation objectively. Journaling your trades is another tool Douglas recommends for mastering impulse control. After each trading session, write down not only what trades you took, but also why you made those decisions. Were they based on your strategy, or did you act on an emotional impulse? By tracking these patterns over time, you'll become more aware of your emotional triggers and better equipped to manage them. One of Douglas's most profound insights is that impulse control is a mental muscle. The more you exercise it, the stronger it becomes. Early on, you might still feel the urge to react impulsively, but with practice, you'll learn to observe those feelings without acting on them. This mental discipline separates average traders from those who achieve consistent, long-term success. Defining your edge is a fundamental requirement for long-term success in trading. Without a clear edge, trading becomes nothing more than gambling, an unpredictable series of wins and losses driven by luck rather than a repeatable process. Douglas explains that your edge is the unique advantage that gives you a higher probability of making profitable trades over time. This edge isn't about predicting every market move, but about consistently following a system that works in the long run. At its core, an edge is a statistical or strategic advantage. For example, it could be a specific pattern, setup, or method that you've tested and proven to produce consistent results. Douglas makes it clear that no edge guarantees a win on every trade. Instead, it provides a probabilistic framework, meaning that if you stick to your edge over many trades, the outcomes will tilt in your favor. Successful traders understand that it's not about being right all the time. It's about executing their edge consistently and letting the probabilities work out over time. One of the key ideas Douglas stresses is that your edge must align with your personality and goals. Every trader is different. Some thrive on quick decisions in fast-moving markets, while others excel with a patient, methodical approach. Forcing yourself to trade in a way that clashes with your natural tendencies creates stress, emotional conflict, and ultimately, poor decisions. That's why defining an edge isn't just about the technical side. It's also about knowing how you think and operate best. Douglas encourages traders to ask themselves a few essential questions when defining their edge. What market conditions do I understand best? Which setups do I find easiest to identify and execute? What timeframes fit my lifestyle and mental focus? How much risk am I comfortable taking per trade? By answering these questions honestly, you can narrow down a trading style that fits both your strengths and your psychological comfort zone. For instance, if you're patient and analytical, you might find success in swing trading or position trading, where decisions are made over days or weeks. If you thrive in fast-paced environments and enjoy quick decision-making, scalping or day trading could be a better fit. Another crucial point Douglas highlights is the importance of testing and refining your edge. It's not enough to assume that a strategy works. You must verify it through experience. This means tracking your trades, analyzing the outcomes, and identifying which patterns consistently deliver results. Through this process, you develop confidence in your edge, which makes it easier to stick to your plan, even during losing streaks. Douglas also warns against constantly switching strategies in search of the perfect system. Many traders fall into the trap of abandoning their edge after a few losses, believing that something else must work better. This strategy hopping mindset prevents you from developing the discipline and consistency needed for success. Once you define your edge, the real challenge is trusting it enough to follow it faithfully, even when it feels uncomfortable. One practical method Douglas suggests for reinforcing your edge is to write it down clearly. Describe the exact conditions for entering and exiting a trade, your risk management rules, and how you'll track your results. This written blueprint acts as a guiding framework, keeping you focused and preventing emotional decisions. When uncertainty arises, you can refer to your defined edge to stay grounded in your process. Douglas also emphasizes that accepting uncertainty is part of working with your edge. No strategy works 100% of the time. There will always be losing trades. But if your edge is statistically sound, losses become part of the larger process rather than personal failures. This mindset shift allows you to approach trading with calmness and clarity, knowing that each trade is just one of many within your overall system. And as Douglas points out, once you trust your edge, you no longer need to chase after every opportunity. You simply follow your plan, trade by trade, and let the probabilities work in your favor. Handling winning streaks is just as critical as managing losses because both can disrupt your mental balance and decision making. While most traders focus on avoiding the emotional pain of losses, Douglas points out that a series of wins can be equally dangerous if it leads to overconfidence and reckless behavior. After a winning streak, traders often feel invincible, believing they've cracked the code of the market, only to make impulsive decisions that violate their strategy. One of the biggest psychological traps after a series of wins is the illusion of superior skill. When trades go well consistently, it's easy to believe that success is purely the result of personal talent or intuition. Douglas warns that this mindset causes traders to downplay risk, ignore their edge, and take larger or more frequent trades without proper analysis. The problem is that markets are unpredictable, and no streak, whether winning or losing, lasts forever. When the inevitable loss comes, an overconfident trader is often unprepared, leading to emotional distress and even greater mistakes. Douglas explains that after several wins, many traders unconsciously feel they are playing with house money. This false sense of security makes them more likely to take risks they would normally avoid. For instance, they might increase their position size, loosen their stop losses, or enter trades without the usual careful planning. The danger here is that even a small mistake during this overconfident phase can wipe out weeks or months of gains. To combat this, Douglas stresses the importance of maintaining emotional neutrality, regardless of whether you're winning or losing. Just as losses shouldn't shake your confidence, wins shouldn't inflate your ego. He suggests adopting a mindset where each trade is simply part of a larger probability game. No single trade defines your success, and no winning streak guarantees future results. This mental framework helps you stay grounded and focused on executing your plan rather than chasing emotional highs. Another strategy Douglas recommends is to review your process regularly, especially after a streak of wins. Ask yourself, did I follow my trading plan precisely, or did I take shortcuts? Were my wins the result of skill, luck, or a mix of both? Am I maintaining the same discipline I had before the winning streak? By answering these questions, you hold yourself accountable and prevent emotional bias from creeping into your decision-making. Douglas emphasizes that staying disciplined after a winning streak is a sign of a mature trader, someone who understands that their long-term edge comes from consistency, not occasional bursts of success. Another key point Douglas makes is the importance of sticking to your risk parameters. After several wins, the temptation to increase your position size can be strong, but he warns that scaling up impulsively, without clear evidence that your edge can handle bigger risks, puts your entire trading career in jeopardy. Instead, he advocates for a controlled, systematic approach to increasing position sizes only after sustained and verified success. Douglas also suggests using self-checks to manage your emotional state. For example, after a winning streak, take a step back and evaluate how you feel. Are you becoming overconfident? Do you feel the urge to take trades outside your plan? These are warning signs that your emotions are taking over. By recognizing these tendencies early, you can recenter yourself before making a costly mistake. Finally, Douglas emphasizes the importance of returning to your baseline after a winning streak. That means going back to the same disciplined approach that produced the wins in the first place. Remind yourself that winning streaks are temporary. They are not an excuse to change your plan. Successful traders accept that the market will always have ups and downs, and their primary job is to stick to their proven process, no matter how many wins or losses they encounter. Releasing attachment to money is crucial for becoming a consistently successful trader. One of the biggest psychological hurdles traders face is the emotional weight they place on money. When you view trades as more than just numbers, when they represent your financial security, dreams, or even self-worth, it becomes incredibly difficult to make rational decisions. Douglas explains that this emotional attachment creates fear, anxiety, and impulsiveness, all of which sabotage your ability to follow a trading plan. At the heart of this concept is the idea that money is a symbol, not just of value, but of what it can provide. For many traders, every trade feels personal. A win brings a surge of excitement and a sense of accomplishment. A loss, on the other hand, feels like a personal failure or a step backward from financial goals. This emotional roller coaster leads to inconsistent behavior, chasing profits when you're winning and avoiding necessary risks when you're losing. Douglas argues that as long as your emotional state is tied to money, you'll struggle to think objectively. He points out that successful traders treat the market like a probability game, where money is simply a way to measure outcomes, not a reflection of their value or future security. Each trade is just one event in a long series, and no single win or loss should carry emotional weight. By detaching from the emotional meaning of money, you free yourself to execute your strategy without hesitation or fear. One powerful example Douglas gives involves traders who start with small amounts and quickly grow their accounts, only to lose everything when the stakes get higher. Why? Because as the dollar amounts increase, so does the emotional pressure. When trading a small account, it's easier to follow the rules because the financial impact feels minimal. But once the stakes are higher, when losing a trade could mean missing a mortgage payment or sacrificing a lifestyle, it becomes much harder to stay rational. The solution? Detach emotionally and view every trade through the lens of probabilities. Douglas suggests that one way to break this attachment is by mentally reframing what money represents. Instead of seeing it as a life-changing resource, view it as a tool for executing your edge. Each trade is a calculated decision based on your system, and the money involved is just how the market keeps score. When you separate your personal identity from your trading results, losses no longer feel like personal failures. They're simply part of the process. Another key strategy he recommends is normalizing losses. Losses are inevitable in trading, no matter how good your system is. By accepting that you will lose money at times and that it doesn't define your intelligence or worth, you reduce the emotional charge behind each trade. This mindset allows you to approach trading with clarity and calmness, rather than fear and desperation. Douglas also emphasizes the importance of setting clear risk parameters. By deciding in advance how much you're willing to lose on any trade, you protect yourself from emotional reactions when things go wrong. This approach allows you to remain emotionally neutral because you've already accepted the risk before you enter the trade. Once the trade is live, there's no need to panic or second guess because you know the outcome is part of a larger process. A practical exercise he suggests is visualizing your trades as neutral events. Picture each trade as simply moving numbers within a system rather than as money being won or lost. This mental shift helps you stay detached and focused on following your edge rather than being swayed by emotional highs and lows. By reframing your relationship with money and focusing on process over outcome, you gain the mental freedom to trade without fear, hesitation, or emotional interference. This detachment is what allows professional traders to execute their plans with precision, no matter the dollar amount on the line. Power of mental rehearsal as a tool to train your mind for calm and effective decision-making during trades. Just like athletes visualize their performance before a game, successful traders mentally rehearse their strategies and emotional responses to stay composed under pressure. Douglas explains that the market environment is unpredictable, but your mindset doesn't have to be. By preparing your mind in advance, you can react with clarity instead of falling into emotional traps. One of the core ideas behind mental rehearsal is that your mind cannot distinguish between real and vividly imagined experiences. When you repeatedly visualize yourself executing trades with precision, managing losses calmly, and sticking to your plan, you're wiring your brain to respond that way in real situations. This process helps reduce anxiety because you've already experienced different market scenarios in your mind. When those situations arise in reality, your brain treats them as familiar, making it easier to respond rationally instead of emotionally. Douglas encourages traders to mentally walk through every step of a trade before executing it. This means visualizing the entire process, from identifying a setup to placing an order, adjusting stops, and handling both wins and losses. The goal is to create a mental blueprint that reinforces discipline and emotional neutrality. By imagining yourself following your plan flawlessly, you're conditioning your subconscious mind to repeat that behavior automatically. He also stresses the importance of rehearsing difficult situations. It's easy to stay calm when a trade goes your way, but how do you react when the market moves against you? Douglas suggests visualizing yourself handling losses with detachment, acknowledging the loss without frustration or panic. By practicing this mentally, you reduce the likelihood of making impulsive decisions when faced with real setbacks. Over time, this approach builds emotional resilience, allowing you to stay focused on your long-term strategy rather than reacting to short-term outcomes. Another key benefit of mental rehearsal is that it helps you identify emotional triggers before they affect your decisions. For instance, if you feel tension when imagining a losing streak, that's a sign you may be emotionally tied to outcomes. By recognizing these emotional responses in your mental practice, you can work on neutralizing them before they surface during live trading. Douglas emphasizes that emotional self-awareness is the foundation for consistent trading behavior, and mental rehearsal is one of the best ways to cultivate it. He also recommends visualizing success in a balanced, grounded way. This doesn't mean imagining yourself getting rich overnight. It means picturing yourself executing your edge consistently over time. By focusing on process-driven success rather than sudden financial rewards, you shift your mindset to one of discipline and patience. This mental shift protects you from overconfidence after wins or desperation after losses, helping you maintain an even emotional state no matter what the market does. Douglas suggests making mental rehearsal a daily habit. Spend time each day visualizing yourself executing your trading plan without hesitation or emotional interference. Imagine every possible outcome, wins, losses, break-even trades, and rehearse responding to each scenario with calmness and objectivity. This consistent practice reinforces the belief that you can handle any situation the market throws at you. He also points out that mental rehearsal is especially powerful when combined with post-trade reflection. After each trading session, review your performance mentally. Did you stick to your plan? Were there moments where emotions took over? By identifying gaps between your mental rehearsal and actual behavior, you create opportunities for growth and improvement. Ultimately, Douglas makes it clear. Mental rehearsal is not about predicting outcomes. It's about preparing your mind to handle uncertainty with confidence. When you visualize disciplined execution repeatedly, you program yourself to act that way instinctively. This preparation removes hesitation, reduces fear, and allows you to approach the market with a calm, focused mindset. Mark Douglas emphasizes that accepting randomness is a critical mindset shift for any trader aiming to achieve long-term success. At its core, this means recognizing that individual trade outcomes are random, even if your strategy has a statistical edge. No matter how perfect your analysis or how confident you feel, you cannot control how a single trade will play out. This realization helps you let go of frustration and emotional attachment to any one outcome. Douglas explains that many traders struggle because they expect certainty from an environment that is inherently uncertain. They believe that if they do enough research, follow expert opinions, or analyze charts deeply, they can predict what the market will do next. But the truth is, no one can accurately predict the market every time. Each trade is part of a probability game where you can't know in advance whether a particular trade will win or lose. Here's the key insight. Over a series of trades, patterns emerge, but individual outcomes remain unpredictable. If your trading system has a genuine edge, it means that over time, you will make more money than you lose. But that edge only plays out across many trades. Trying to force certainty onto a single trade is where most traders go wrong. They become emotionally invested in being right, and when the market moves against them, it feels like a personal failure. Douglas uses the analogy of a casino to drive this point home. Casinos know that every spin of the roulette wheel is random. They have no control over whether the next number is red or black. But because the house has a small statistical advantage, they are guaranteed to profit over thousands of spins. Similarly, if you stick to a strategy with a proven edge, you don't need to worry about individual wins or losses. Your focus should be on consistency, not predicting the next outcome. Accepting randomness also helps reduce emotional extremes. When you fully internalize that each trade is just one of many, you stop reacting to wins with euphoria and to losses with fear or frustration. Douglas explains that most traders sabotage themselves by letting their emotions take over after a few winning or losing trades. If you win, you might become overconfident and start taking reckless risks. If you lose, you might become hesitant or revenge trade to recover. Both reactions stem from the belief that you should be able to control outcomes. But once you accept randomness, these emotional swings lose their power. A practical step Douglas suggests is to reframe how you view losses. Instead of seeing a losing trade as a mistake or failure, see it as part of doing business. Just like any business incurs expenses, trading comes with inevitable losses. As long as those losses are within your defined risk parameters and your system has a long-term edge, there's no reason to take them personally. This mindset shift frees you from the emotional burden of trying to be right all the time. He also emphasizes the importance of tracking probabilities instead of outcomes. Successful traders don't obsess over whether the last trade was a win or a loss. They focus on executing their process consistently. If your edge suggests that 60% of your trades will be profitable, you must accept that 40% will lose, and there's no way to know which trade will fall into which category. By focusing on the bigger picture rather than individual results, you detach emotionally from any single trade. Douglas advises traders to predefine their risk before entering a trade. This means deciding exactly how much you are willing to lose if the market goes against you. Once you've accepted the risk, there's no reason to feel anxious or surprised if the trade doesn't work out. It was always a possibility. This practice reinforces the mindset that every trade is one event in a much larger statistical framework. Another key point he makes is to trust the process, not your emotions. Feelings of excitement, fear, or frustration are natural, but they have no place in decision-making. Your job as a trader is to follow your system with discipline, knowing that randomness governs individual trades, but probabilities govern long-term results. The more you trust your edge and stick to your plan, the less power emotional reactions will have over you. By fully embracing the concept of randomness, you gain emotional freedom. You no longer panic when a trade goes against you, nor do you become overconfident after a win. You understand that your job is not to predict the future. It's to execute your system consistently over time. This mindset shift allows you to stay calm, focused, and in control, regardless of short-term outcomes. If you found these topics helpful, make sure to like, share, and subscribe to the channel. Your support helps us bring more in-depth content to sharpen your trading skills and mindset. Thanks for watching, and I'll see you in the next video. Happy trading!